Hi traders, this is Matt. Welcome back to Zen and the Art of Trading. Today's video we're going to be covering trend and market conditions such as consolidation and trend reversals. There are a few very important fundamental concepts that you must master before you can ever find success as a trader, such as how to read trend, candlestick patterns, and so on. Today's particular video is going to focus purely on trend. It's very important to have clear rules defining exactly when and when you cannot act on a market. The purpose of these rules and this systematic approach to trading is so that you can develop consistency in your process. You can't improve what you don't measure. That is more true of trading than of anything else that I've ever experienced in my life. Of course, you can't remove all subjectivity in trading. It's impossible. That's due to the probabilistic nature of markets and the inherent uncertainty that we are confronted with every time we open our charts. But by having strict rules that govern our behavior in the market, we can determine whether or not what we are doing is working. And before you can make money as a trader, you must be consistent. All profitable traders know this, and all unprofitable traders struggle with this. Hopefully this video today will clear up a lot of uncertainty you have around how to read a trending market, and I will show you one of the best ways to objectively determine the market's trend, which is a method that was passed down to me from my own personal trading mentor, Stephen Hart. Let's start with a blank chart here, and I will draw out what I consider to be a bullish trend and a bearish trend, and then I will explain the concepts to you. So I'll start with a bullish trend. The textbook definition of a bullish trend is a market that is making higher lows and higher highs. We've all heard that before, and it sounds good in theory, but as you will see later when we go over to live charts, it's a lot easier said than done to determine a trending market. But hopefully this concept I'm about to teach you now will help. All bullish markets must begin with what we call a 1, 2, 3 move. So that looks like this on your charts. Market makes an impulsive move higher, then it pulls back without breaking the low of the initial impulsive move. So we can come all the way down to the beginning of the move, but it cannot close lower than it. So a typical trending market will look something like this. It'll pull back somewhere within this impulsive move, and then once we get a second break and close higher above this high here, we have the beginnings of a potential bullish trend. We don't necessarily have a bullish trend yet, but this is the bare minimum we need to see before we can determine that a market is trending higher. In order to confirm that we have a bullish trend, this next pullback can come all the way down to the origin of this impulsive move, but again, cannot close below it. So if we get a pullback all the way down to here, and then the market breaks higher, right now, this scenario is a bullish trend, according to how most professional traders read markets. Now, this pullback doesn't have to come all the way down here. Of course, it could end somewhere in the middle of this impulsive move, like here, for example. This is still a valid bullish trend. Quite often, you will see the market in a very strong bullish trend. It will pull back into previous resistance before finding support and moving higher. Now, this is an ideal bullish trend. Not all bullish trends will look like this, however. So I will show you examples later on where things aren't quite as clear as this. But right there you have a textbook bullish trend. And so long as this market continues to make higher highs and higher lows without taking out the previous low, we have a bullish trend. So if this market were to start pulling back anywhere within this range here, means that the market is still in a bullish trend, which means that it is likely to continue heading higher in the long term. It is more likely to continue heading higher in the long term than it is to suddenly reverse. What that means to you as a trader is that any trading opportunities you take on this time frame or any lower time frame should have a bullish directional bias. Any trading opportunities that you take while this is occurring that have you going short should be considered counter-trend trading opportunities and treated as such. What that means is you shouldn't expect to capture a massive amount of profit in a counter trend move. I don't want to get too complicated with this, so I'm not going to explain counter trend trading in this video. I'm going to stick with trend continuation trading because that's how I prefer to trade and it's my specialty. If you want to learn how to counter trend trade, there are many other people out there who are far more qualified than me to teach you that. So keep that in mind. We're going to stick to trend continuation and momentum trading in this lesson. So right there, we have a bullish trend. So just to recap, each time this market makes a low and then a new high, the bullish trend is considered intact until one of these lows is closed below. So you can see here in this crude example that none of these lows were taken out by price action. If I delete these lines and we focus on this line here, now I will show you an example of a potential trend reversal / rotation into consolidation. So if this market were to come up and try to make a new high, and say it double tops up here, fails to make a new high, and then it reverses, and then it starts to do something like this, comes back down to retest this low. Right now we have a period of consolidation. What that means is that although the trend is still to the upside, it has lost steam and it's now going sideways. Now, if these lows aren't taken out during this period of consolidation, then your bias should still be to the upside, which means you could be taking long trades down at these lows if your strategy has an edge in doing so. But just as I mentioned earlier, that if you're taking counter trend trades against a bullish trend, your profit potential is limited. The same is true of consolidation. What I mean by that is, if you are going to trade consolidation from these lows, in this example, say you go long down here after getting a entry reason, you should be looking to take profit before these highs, because the market is not showing that it wants to move higher yet. So what could happen here, and what is likely to happen here, is that this market will continue consolidating. And so if you were to go long here and hold your position waiting for a trend continuation move after we've entered a period of consolidation, you're likely to see this market come all the way back down and stop you out, either for break even or for a loss. So during consolidation, it's best to be conservative with your profit targets. So now that we've got an example of consolidating market, which is still in a bullish trend because we still haven't taken out these lows. But what happens if we do take out these lows? That would look something like this. A break and close below these lows here would signal that this consolidation period may be entering a potential trend reversal situation. So what we're looking for now, just as we had this 1, 2, 3 bullish move here that signaled a potential beginnings of a bullish trend, but is not confirmed until we have that third break and close above this high. The same is true of a reversal. Now that we've broken out of this period of consolidation, that does not mean that we've immediately entered a bearish trend. What it does mean is that sellers are taking control of this market, and that if we find resistance somewhere before these highs, and then we roll over into another low, we now have a bearish trend reversal and have entered a bearish trend. Once we get this 1, 2, 3 move, we are now anticipating price continuing lower until price breaks and closes above this high. We have a bearish trending market. So what that means now is that if this market pulls back up and does not break and close above this high here, then we are anticipating the market continuing lower in a bearish trend. So you can see that according to this rules-based method of determining trend, it's identical to the bullish trend, just in reverse. Instead of waiting for the lows to be broken and closed below in order to signify a reversal in trend, we are waiting for the highs to be broken and closed above. So as long as this market continues to make lower highs and lower lows without breaking and closing above this previous high in the bearish trend, then we have an intact, valid, bearish trending market. So let's presume that this market continues making lower highs and lower lows without invalidating the trend. Then let's say that instead of consolidating here and making a low and then failing to make a new lower low and then ranging like we did up here before reversing, let's do an example of an immediate trend reversal, a V-shaped trend reversal. So say that this market makes a new low and then immediately following that new low, it breaks and closes above this high. Once this happens, we have an invalidated bearish trend. It does not mean that we now have a sudden bullish trend. Keep that in mind. What it does mean is that the momentum to the downside has been lost and bulls have regained control of this market, at least for the time being. What this means as a trend continuation trader is that you should stop taking short trades, basically. It doesn't mean you should suddenly go long, but it means that you should stop taking short trades and wait to see what the market does next. Your bias now should be neutral until the market forms a new clear trending direction. Now what that would look like is if the market were now to pull back and make a new low that is higher than this low and then break and close above this high, now you have the beginnings of a potential bullish trend. And so during this next pullback, depending how conservative you are or aggressive you are, you could begin looking for bullish trading opportunities, for long trades, in anticipation of a bullish trend reversal. But keep in mind that we do not have a confirmed bullish trend until we get one more break and close above this high, because we have this impulsive move up here that broke structure, putting us into consolidation, potential consolidation, and invalidating the bearish trend. Once we have this situation here, then the same rules that applied here come into effect. So until this market breaks and closes below this low, then anything that happens in this pullback is considered to be a bullish trending pullback, meaning that we are anticipating this market continuing into new highs, and therefore your bias should be to the long side. Now, keep in mind that all of this is subjective according to what time frame you're trading. So if you're trading the daily chart here, for example, then when this pullback begins to occur, on lower time frames, this pullback will look like a bearish trend. So on a 4-hour or 1-hour chart, you will see the market making lower highs and lower lows. That's why it's important to have 2 time frames that you trade with and use one of those time frames as your higher time frame reference point. Depending on what time frame you're trading, that could be the daily or the 4-hour or maybe the 1-hour chart. If you're trading a 5-minute chart, you might want to use the 1-hour chart as your reference time frame. The reason for that is that a daily chart's movements do not have a lot of bearing on a 5-minute chart. It does around structure, but again, that's for another discussion, another day. We're not talking about structure today, we're just talking about trends. But keep in mind that this analysis, this trend analysis that I'm showing you, should be performed on your higher time frame. So at the moment, I'm a 4-hour trader. I trade the 4-hour time frame and the 1-hour time frame. And I use the daily chart as my higher time frame for determining my trend bias. And whatever the daily trend bias is, determines what setups I'm looking for on the 4-hour and 1-hour chart. So if the daily trend is bullish, then I'm looking for 4-hour bullish setups. And of course, the ideal situation would be that your higher time frame is trending to the upside or the downside, and your trading time frame is also trending to the upside or the downside. If you have 2 time frames trending in confluence, that dramatically increases the probability of your trade being successful. So that's a crude illustration of the theory behind trend analysis. My trading mentor has been using this method for many years now with massive success. If you want to learn more of this stuff in detail, I highly recommend going and checking out his course, the EAP Mentorship Program. You can find that at thetradingchannel.net. Now let's move on to some live chart examples, because the theory is all well and good, but I know all too well that once we get into live charts, it gets a lot more difficult to see this stuff. So for simplicity's sake, I'm going to focus on just this part of the market going forward. Okay, so we're going to ignore all the price action to the left here. Sorry about the flickering here. That happens whenever I put my mouse over the candles. This black box is there to just take your eyes off that. We're just going to look and pretend that the market started where it is. So I'm going to put the replay tool on to make this easier. I'm going to zoom in a little bit, and I'm going to play this back bar by bar, and we're going to analyze the trend as it develops. Let's begin. Okay, we have our first impulsive move lower here. Now, you can see that we've had a pretty substantial pullback now. I class a valid pullback in a trending market as 2 large green candles in a row, at least 2 large green candles. Now, this is where a bit of subjectivity comes into play. You know, how large does the candle have to be? What about the wicks? Does a doji count? And so on. I'm going to have to leave that up to you to determine your own rules for deciding that. This video is going to be far too long if I go into the nitty-gritty details. We have this scenario unfolding right here. And as I said in the theory section, if price does not break and close above this high, but it does break and close below this low, after this pullback has occurred, then we have our first 1, 2, 3 move, which signifies a potential bearish rotation. So let's play this market forward a little longer. And there we have it. We have a break and close below this low, which gives us our first bearish 1, 2, 3 move. Let's continue forward. We get another significant pullback here, as you can see. But during this pullback here, our bias should be to the downside. We are anticipating that this market will more likely head lower than it will suddenly reverse. So we have our next pullback here, and until price breaks and closes above this high up here, we have a potential bearish trend. So let's roll the market forward, and there we go. Now we have a confirmed bearish trend. We have lower lows and lower highs coming in. And again, until we break and close above this high here, we are expecting the market to continue lower in this bearish trend. It doesn't matter what it does between this low and this high, so long as it doesn't break and close above this high. So long as that happens, we are anticipating the market to continue lower. So let's continue forward. Another significant pullback. Very interesting situation here. You can see the market came up to test this high. It broke through the high, but did not close above it. What this typically signifies is a stop-loss hunt. And so market movers know that people put their stop-loss above highs, and that is the importance of waiting for the close of the candle. If you were to try to buy this breakout here before this candle closed, you'd be trapped in this trade. You don't want to be the small fish getting caught in the big guy's net. That's what this trend analysis training is designed to help you avoid. This is a great example of a bullish trend remaining intact after the previous high was contested. So you can see the market came up, tested this high, did not break and close above it, and we're starting to roll over. So let's play this market forward and continue. Remember, we are anticipating this low down here being violated. Until this market breaks and closes above these highs up here, closes, not just breaks, but closes, the candle must close above these highs, then we are anticipating the market continuing lower. So let's see what happens. So now we've come down and we've tested these lows. We've failed to break through them, which is interesting to note. And depending on what happens next, if we get another significant pullback after this failure to make a new low, then we have entered a period of consolidation. So keep that in mind. There you have it. We've entered a period of consolidation. So now, between this high and this low, we've lost bearish momentum and we're now consolidating. But the market is now going sideways. What that means is that if you're a trend continuation trader, Depending on your trading plan rules and what you've backtested to find profitable and give you an edge over the markets, you should stand aside here. Stop taking short trades until the market makes a new low. The reason for that is that the probability of your short trade winning has now dramatically decreased because the market's going sideways. Now, it's an advanced topic. I'm not going to get into it in this video, but during these periods of consolidation, there are ways you can trade them, but it requires a different approach to trend continuation and trend trading, such as advanced patterns, consolidation patterns, range trading, so selling at the highs and buying at the lows, mean reversion trading, so waiting for an oscillator like the RSI to go overbought or oversold within this consolidation period to trade it. There are many ways to trade consolidation, but that's outside of the scope of this video, so we won't go over that now. But let's just play the market forward. Remember that even though we're consolidating, until we break above these highs, break and close above these highs, we are anticipating the market moving lower and making new lows. So that's what I'm expecting out of this market. And there we have it. Now I know this is hindsight bias. We did look at the chart before I did this analysis, but this stuff works in live markets just as well. So even though I cherry picked this trend example, I only did so because it has such great examples of these concepts. But if you go out and try this yourself, test this yourself over many years of historical price action data or many months of forward testing, you'll find that it is very effective at determining the direction of price action. So we've now made a lower low from this high, and the bearish trend is back in force. So until we break and close above this high, we have a bearish trend. So let's play the market forward, expecting the market to roll over to the downside and make a new low. And we've entered another period of consolidation. We came up, made a high, then we tried to take out these lows and enter into a bearish trend continuation, but we failed. We failed right at the lows. So now, until we break above this high or break and close below this low, we are in a period of consolidation. The market is going sideways and your bias should be neutral with a slight bent towards the downside, because we still do have a bearish trend intact until this high is closed above. So keep that in mind. Let's move on, see what happens. And there we have it. We have our first sign of a potential bullish reversal. We've broken and closed above this high, and now we're out of a bearish trend, but still technically in consolidation. What we need to see now is another pullback that does not break and close below this low, and then an impulsive move higher that breaks and closes above these highs in order to have a bullish trend reversal. So right now we do not have a bullish trend reversal, but we have a potential bullish rotation. So keep that in mind. I know it's a lot of concepts to juggle, but it'll make sense with practice. Just keep watching this video over and over if this doesn't make sense to you. But let's play the market forward and see what happens. Do we get a 1, 2, 3 move? We do. So you can see the market's pulled back, made a low that was higher than this low, and then we've broken and closed above these highs. So now we have a trend reversal situation occurring. So let's play the market forward and see what happens. So you can see that this market, after making a 1, 2, 3 move, has pulled back, but not closed below these lows. This is the last line of defense in this bullish trend. Remember that. We pulled right down into that zone and failed to close below it. So depending how you trade, there may have been a trading opportunity down at these lows. You drop down to your 4-hour chart and look for price action patterns in this zone. So remember, even though we're now on the 4-hour chart and this is a bearish trend happening, we've got lower highs and lower lows, the daily trend has just turned bullish. So let's play this market forward a little bit. And so I don't really see any way to have entered this initial bounce out of this zone. But here I see a hammer candle with a long wick to the downside and a small body at the top. So there's a trading opportunity right there that I can identify. based on this analysis. And so how you would trade this is you would have your stop loss, 1 ATR, or whatever you backtest and find profitable, below this low, and a target at least a 1-to-1, I would recommend, if not higher. But in this case, a 1-to-1 would have given you a profitable trade out of this structure zone in here. And that is how you would use this trend analysis to identify trading opportunities and develop a bias, an intraday trading bias or a swing trading bias. So just to recap, you can see that we had a bearish trend occurring. We had an impulsive move lower here, a pullback that did not break and close above this high, then another impulsive move that did break and close below this low. We had another pullback that created a new high that did not break and close above this previous high in the trend. And then we rolled over into a new low. Then we had yet another pullback that tested the previous high in the trend, but did not close above it. We did not get a candle close above this high. So the bearish trend was still intact at this point. And then we rolled over. We went into a period of consolidation, a short period of consolidation, and then made a new low. Once we made this new low, we had a pullback that did not break and close above this high. So we had a bearish trend still intact. And then we tried to roll over into a new low, but failed. And we double bottomed down here. Immediately after this double bottom, we had an impulsive move higher that broke structure to the upside and did in fact close above this previous high during this consolidation period. Once we had this break and close above this previous high, we had a pullback that did not break and close below this low. And then we had an impulsive move higher that did break structure here. Now we have a bullish trend. And I just showed you how you could take advantage of that on a lower time frame, like a 4-hour chart or even a 1-hour chart. If we go to a 1-hour chart, you can see we had a nice clean double bottom in here and somewhat of a head and shoulders pattern in here. You can see that we came down, made a left shoulder, had a pullback, then broke through, made a head, pulled back, then made a right shoulder, and then we broke out of the neckline of this head and shoulders pattern. So you could have gone long anywhere in here, or on this pullback here after the confirmed break, or even on this right shoulder. There are many opportunities here to get long out of this zone and capture a decent bounce out of this market on these lower time frames, just using higher time frame trend analysis. So that's a really long-winded demonstration of trend analysis. I hope you found it helpful. I hope it wasn't too confusing for you. If you did find it very confusing, it may help to watch this video over a few more times. It took me a while. It took me quite a long time, actually, to grasp these concepts, and I'm still making mistakes occasionally. If you're skeptical or this didn't make sense to you, go to thetradingchannel.net and you can learn this stuff straight from the man himself who taught me this information. Alright, so before I leave you guys, I figure I should probably show you a quick example of a bullish trend. Of course, you saw at the beginning in the theory section, the bullish trend is basically the same as what I just showed you, except in the opposite direction, obviously. But let me show you a real life price action example of applying these techniques to your charts. So we're on the S&P 500 here, as everyone knows, or you should know. This has been trending to the upside for several years now. And this trend analysis works quite well even on this market. It's not a Forex market, but it's a market that exhibits price action, and price action is the same across the majority of markets in existence, including crypto for that matter. So let me start out by replaying this market from where it is. You see we're in a period of consolidation here, but then we get a break and close out of this consolidation. So we have our first 1, 2, 3 move here. We have an impulsive move higher, pullback, and then another impulsive move higher out of this period of consolidation. And so if we do not get a break and close below this low before we get a break and close above this high, then we have a bullish trending market. So let's continue and see what happens. Waiting for a significant pullback. There we go. I would class that as a significant pullback. So we've made our 1, 2, 3 move here, and now we're pulling back. Until this market breaks and closes below this low, we are anticipating it continuing higher and breaking and closing above this high first. So let's see how that plays out. And there we have it. We have a new impulsive move higher. We're waiting on a significant pullback. And then we can start drawing out our next low and high. I'd class that as a significant pullback. So it's 3 red candles in a row. So the way I draw this out is we have this 1, 2, 3 move, pullback. We've made this low. We did not break and close below it. And then we had an impulsive move higher that broke and closed above this high. Then we had a pullback. And then we made a new high. So let's continue the market forward and see what happens here. Very interesting. You can see that we made a new high from this low. And then we had a bit of a panic selling situation here, it looks like. But look what happened here. We did not close below this previous low. See? And just like in the previous example on euro dollar, what we have right here is an old-fashioned stop loss hunt. The people have been trailing their stops below this low. Market movers know that. They push the market below there to absorb all the orders down here. And now, until we get a close below this low, the market is likely to continue higher from here. So let's see what happens. There we go. We've got a new high formed. So this trending market is still intact until we break and close below this low. So there we have our, I would consider this a significant pullback because we had 2 red candles in a row. Decent size in the context of this move. And then we made a new high. So now, until this market breaks and closes below this low, what are we expecting? That's right. We're expecting the market to continue higher. I know I'm repeating myself here, but this is trading. This is consistent rules-based trading anyway. It's not very exciting. I'll be the first to admit that. But clearly it works. And if you want to make money in the markets, you got to forget about excitement, focus on what works. And this works. Let's watch it continue to work. Okay, very interesting. There you go. See, we had a few more stop loss hunts, but we did not break and close below this low. We had some wicks test there, but none of these candles closed below this low. So the bullish trend is still intact. We had our pullback into this low, and then what did we do? We went into trend continuation higher. Now we have another significant pullback. But until this market can take out these lows and close below them, we have a bullish trend. So this pullback here, we'll see how this unfolds. There you have it. We've continued into new highs. We had a pullback that did not break and close below these lows. And then after testing these lows, the market continued higher into trend continuation. So you can see there are multiple opportunities to take advantage of this trend analysis just on this chart alone. And if we drop down to a 4-hour chart, I'm sure that there were several opportunities. A bullish engulfing candle right there, straight off this zone. A double bottom in here, off this previous low. Now here, the candles did close below the low, but this is on the 4-hour chart, not the daily chart, remember that. So this occurred during the daily session, and we had a nice big wick rejection with a bullish engulfing candle. Great long opportunity right there to profit off all of the people who were trapped short and follow the big money who just wiped out everyone's stop losses below this low. So there's just a few examples of how you can use this trend analysis to identify trading opportunities. Not to mention all of the opportunities that occur within these swings. So you've got flag patterns that form that you can trade breakouts of. You've got pullback setups, such as this here. You can see you've got a bullish engulfing candle. Now, if I throw on my ultimate pullback indicator, some of you watching this are trial members and paid users of my ultimate pullback indicator. This trend analysis that I'm showing you is exactly how I trade this pullback indicator. I'm giving away a little bit of secret sauce here for you non-paying members, but for paid members of my pullback indicator, I'm going to go into great detail about how I personally trade this indicator profitably. And this is a perfect example of a trading opportunity that I would take based on this daily analysis. So I think that'll do it for this video. I think I've gone over enough examples here and situations to give you a pretty firm understanding of how I read trend. You can see here that once these higher time frame trend continuation swings begin kicking in, there's just so many ways to take advantage of it. You've got flag patterns everywhere. You've got pullback opportunities, wedges, all kinds of ways to take advantage of this trend analysis. Using this trend analysis to determine your intraday trading bias, your directional bias, can be an extremely effective way of trading the markets with a high win rate, high probability, high risk reward trades. You can capture some fantastic profits out of these markets with very tight stop losses in many cases. This analysis applies to all markets I trade, all currency pairs, all time frames. I hope you found this video interesting. If you have any questions, feel free to leave them in the comments section. And if you want to learn more about this stuff, head over to thetradingchannel.net and Stephen Hart will take care of you there. Thank you for watching. Thank you for your time. If you enjoyed this content, please hit the like button or subscribe to my channel because I've got plenty more stuff on the way. Good luck with your trading, everyone. Take care. I'll speak to you soon. Goodbye.